There is panic in the markets. What is in store here for 2025? I often like to say red days like we have seen at the start of 2025 is when true wealth is built. How often have you looked back to more recent years like 2022 or 2020 and said, man, I wish I bought more of fill in the blank. These are those opportunities. And in today's video, we're going to be talking about two of the more popular dividend-focused ETFs, one being SCHD, the other being JEPQ. Both of these, big-time yields, but very different strategies. And we're going to look at, by the end of this video, which is the better buy, if not both of them. So before we dive into both of these, do me a huge favor, show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And let me thank today's video sponsor, which is Snowball Analytics. I love Snowball Analytics, and if you are a dividend investor, you're going to love it too, because they have some fantastic investing dashboards for value investors. They have dashboards to show your entire portfolio, dashboards to help research stocks, but one of my favorite dashboards is the dividend calculator, which shows your dividend payout by month and annually to help you track your progress of meeting your dividend goals. As of right now, you can try out Snowball Analytics completely free for 14 days by using that link down in the description below. Give Snowball Analytics a try today. All right, let's jump back into our video now, taking a look at two popular dividend-paying ETFs, SCHD and JEPQ, also known as JEPQ. Although both of these ETFs are very popular, they're very different from one another. Let's begin by taking a look first at SCHD. This is more of your traditional ETF route. It tracks the Dow Jones US Dividend 100 Index. It's set up by an algorithm that every March chooses 100 stocks based on underlying fundamentals, dividend sustainability, and more. So there's not really any human element that goes into it. Plenty of investors, myself included, were really disgruntled about the updated 100 stocks for 2024 because the likes of Broadcom, which happened to be the largest position within SCHD at the beginning of 2024, was excluded from the list. And again, it's all part of the algorithm. It was because of the big swing up that the stock had. But imagine the performance of SCHD last year if Broadcom was yet again the top position. What could have been? But essentially, this is a ETF that holds 100 stocks. It's updated every single year, and it's rebalanced on a quarterly basis. Now let's take a look at the comparisons to that of JEPQ. JEPQ, on the other hand, is much more of an income-focused ETF. SCHD is equity and dividend, where JEPQ, most investors are focused on that big, juicy yield, which we'll take more of a look at here in a little bit. See here with JEPQ, it is an active ETF, meaning there is heavy human involvement, which coincides with a larger expense fee. And they're buying underlying assets in and out of them on a regular basis. And on top of that, they are selling out of the money call options on the likes of QQQ or the NASDAQ 100. The latter part of that strategy is what generates that high distribution yield. They receive a dividend from the stock they own. Then they also receive premiums from the options that they sell. Those combined is what they pass on to the shareholders. Selling out of the money covered calls is a strategy that I utilize on a regular basis. And you can learn this strategy by signing up for our newsletter, The Stock Investor's Edge, where we have an Options Edge Plus subscription, where we give out a weekly report based on education and a trade idea every single week. Check out the link down in the description below. So getting back to these two ETFs, SCHD buys underlying positions based on the algorithm, high quality companies that pay dividends, growing dividends, a lot of them, whereas JEPQ still buys underlying assets, many of them technology companies within the NASDAQ 100, but in addition to that, they sell out of the money covered calls to juice that premium even higher. So the strategies to a degree are very different. Now let's take a look at performance for both of these ETFs. Since JEPQ's inception back in May of 2022, shares have outperformed that of SCHD, but it is a small sample size. JEPQ is up 9% with SCHD up only 4%. On a total return basis, the disparity is even larger, in favor again of JEPQ, where they are up nearly 50%, whereas SCHD is up only 15%. Now, I never like to take a small sample size as the standard, but that's all we have with JEPQ. SCHD, on the other hand, has been around for years, and when we take a look at the 10-year total return for it, we see 183% return. On average, that's 18% per year, which is rather good. And prior to the massive 2-year run we have seen in the markets, particularly from mega cap technology stocks, SCHD has actually outperformed the S&P 500 for the decade prior. Those are sample size I give a lot more weight to. So again, both of these can be viable investments, but it comes down to the investor and their strategy. And it's also important to understand the strategy that JEPQ or the likes of JEPB are utilizing by selling covered calls. Here's a good illustration showing some of the downside. When you sell a covered call, you are receiving income right out of the get-go, but you're also on the hook to sell shares if the stock price exceeds the option strike price. In this example, the option price is the blue dotted line, whereas the underlying equity price is the red line. As the red line continues to rise and rise, the covered call caps its upside potential because it agreed to sell the shares at a predetermined price. Any upside above that predetermined price does not go to this ETF. Those are some of the major differences. However, when the index like the NASDAQ is trading sideways or even down, we're seeing some red days, something like a JEPQ can provide a hedge to investors' portfolio, because in that case, those covered call strategies are much more profitable. Now let's take a look at some of the top positions in the ETF, beginning with JEPQ, where we see the likes of Apple, Nvidia, Microsoft, Amazon, Alphabet, Broadcom, Meta Platforms, Tesla, and Netflix. Mixed in between there is an equity-linked note. That is where you find those option plays. So when these underlying positions increase in value, it definitely helps the value of the ETF. But it depends on how close to the money those covered calls that they were selling are at. If those covered calls end up being less profitable, that's going to weigh on the distribution yield. There's not going to be as much to pass on to the investors. That's why you see the distribution yield, it can be quite volatile if you look at it over the past few years. For example, looking at this chart here, this is showing the distribution yield for JEPQ since its inception. Early on, the yield was well over 12%. However, the NASDAQ has continued to climb over the past few years. The trades have become less profitable, thus reducing the yield that they're able to generate. The yield as of this video sits at 9.7%, and it is paid out on a monthly basis, which some investors tend to like. Now let's take a look at SCHD, where the top 10 positions include Pfizer, AbbVie, Cisco Systems, Coca-Cola, Texas Instruments, Bristol-Myers Squibb, BlackRock, Amgen, Chevron, and Verizon. Over the course of the past few years, this is probably my least favorite top 10 that I've seen with SCHD, especially last year when they lost the likes of Broadcom. That really weighed. So to say that I'm looking forward to March 2025 when that reconstitution takes place is going to be an understatement. As for the dividend, though, this is where SCHD separates itself from other dividend-focused ETFs. It has a larger yield than most high-yield ETFs. It has a faster dividend growth than most dividend growth-focused ETFs. The yield currently sits at 3.7%, the 5-year dividend growth rate at 12%, and 13 consecutive years of dividend growth. I love ETFs and stocks that regularly increase their dividend year in and year out. And when we're talking about those comparisons, I'm talking about more traditional ETFs. Obviously, JEPQ has a much higher dividend yield. So which of these is the winner, you might ask? Well, again, it's going to come down to the investor. I utilize both of these ETFs. SCHD, I like to utilize as a long-term position. JEPQ, I like to utilize as a short-term position. Anytime I build up a large amount of cash, I tend to go in and out of the likes of JEPQ until I find a home for that money to be invested in. There's really two main, pretty simple reasons on why I don't make JEPQ a long-term position within my portfolio. Number one, it's that capped upside. Number two, this is a strategy that I already utilize within my own portfolio, leveraging my own shares. So why would I pay 0.35% expense fee for something that I'm already doing on a regular basis at a very successful rate. These are things that we pass on within the Stock Investor's Edge Options Edge Plus subscription. But when it comes to SCHD, this 100% has a position, a long-term position within my portfolio. And there's 3 primary reasons on why I love SCHD. Number 1, the tech exposure, especially with Broadcom coming out, which wasn't a great thing, but the tech exposure is lacking, which makes it a great complement to both the likes of the S&P 500 or tech-heavy positions within your portfolio. Number 2, it has consistently paid a safe, reliable, and growing dividend. And number 3 is that strong dividend growth. That allows for the power of compounding to be put into overdrive. But if it came down to it, and you forced me to pick one, which you might be doing, it's going to be SCHD because I'm a long-term investor first and foremost. But down in the comment section below, let me know which of these 2 ETFs do you prefer within your portfolio. Every investor is going to be different. You're going to have some retirees that are going to love the likes of JEPQ because they are just really focused on the yield, and that's the only focus. So for them, it might work. But for me, still trying to build and accumulate more and more wealth, I want the share price appreciation as well as that dividend growth to go in as a part of my portfolio. So again, I hope you enjoyed this video. And if you like these types of videos and you want more different comparisons, definitely let me know down in the comment section as well. And if you haven't done so, make sure you smash that like button, subscribe to the channel, and we'll see you in the next one. Take care.